Hey YouTube, this is Damien, and I just want to say that I was 19 years old when I was living through one of these cycles. Now, age and different things that happen in a market environment and in the world can shape your perspective. At the time, I was listening to Robert Rector. I was reading his book, Conquer the Crash, and he published the book in late 2002. We got into the war in Iraq in 2003, and the market just took off. I was expecting the crash that he had in his book. So you don't want to put too much influence on one person. There isn't this one guru or market analyst that really can forecast the future. But at the time, I was expecting the correction to continue. And this is a chart of the 2003 correction as it was published in Investors Business Daily. So these are 8 bars in this phase. This is the first one that they have, where it would have saved you some money just by not participating in the market. Now, everything that wasn't published before then didn't really have the code that we're looking for. So what is it that we're looking for? We want to see if the market's in a correction, if the market state is in a sideways pattern or uptrend under pressure. The market moves in mostly uptrends, so any move against it is an uptrend under pressure or a correction against that uptrend. So here we have price making lower lows and lower highs as price closes below these moving averages. That's the 50-day and the 225. I use the 225. So if we zoom in, we can see that the 7.41% drop would have just kept you out of trouble. So after the correction, we have a massive rally that ensued, and that's what I discussed in the last video. So here we have some other factors working. How institutions sell before a market goes into its sideways pattern or uptrend under pressure, it really depends on how much distribution there is. That's how much the institutions are selling. So in this case, we have a false signal where the market became it turned into a state of correction, and so that's indicated by that red arrow right there. There was a decline of 5.65% that led up to that. What we're going to be looking for is how much staying power these signals have. So in this case, it didn't have any. There were green candles that happened right after, and it led into another market rally. So you have a little bit of a correction or rally under pressure, and the market just went right back into rally mode. So that rally mode not only eclipsed this downtrend right here, but went up 5.64%, 35 trading sessions, where it went back into a sideways move. So if you zoom out, you can see that the sideways move wasn't really that powerful, and the sellers didn't really have that much control here. They just were able to drive the price right back down to the moving average, and then the stock market just started going higher from there. So these are a couple of phases that we discussed, and we'll see how we can take advantage of using this as a timing tool and how to use these candlestick patterns and trend indications to profit from price action in the market. So this is a follow-up to last week's very big move that happened in the rally of 2003. So you can say that some of these corrections never really happened in any significant degree. That price just went right under the moving average and then went back up. So there's the sideways action. It was one of the first market rally under pressure. They usually end in some kind of resolution in case there was a drop that happened after that, and then it went right back into the rally. So I'm going to be talking about the rally that happened after the sideways pattern in the next video, and I'm glad you enjoyed. Stay tuned.